from Singapore. He needs no introduction, founder and fund manager with Helios Capital. Samir, good morning. Good to have you back on ET Now. Thank you for joining us. It's slightly late to exchange pleasantries, but wish you and your family a wonderful 2019 ahead.
No, thank you very much, Nikunj. And it's never late to get good wishes or to give good wishes. So happy New Year to everybody. Still 51 weeks left.
Still 51 weeks left, but do you think those 51 weeks from a market standpoint, will they be good weeks or will they be choppy or volatile weeks?
Well, individual weeks could be choppy, but overall collection of 51 weeks, I don't think will be very bad for India. It's not been bad even so much in 2018. But 2019, just because we don't normally have so many bad years in a row, I think even otherwise should be okay. I feel good.
Fueling your optimism, is it flows, it is liquidity or earnings recovery?
Well, it is a little bit of dealing with a lot of issues in 2018 and those no longer posing a challenge. So first of all, let's do big picture that in any case, equity markets over long term do well, right? So that is always the backdrop which pushes things up at the rate of your earnings growth, which are whatever 14, 15%. But last year, because of the currency depreciation and then the real estate stroke NBFC scare, we were, and also the mid-cap correction, the Indian markets did very badly in the initial part of the year. And we can see for the last 2-3 months that with the oil price decline and with hopefully interest rate cut and the fact that currency depreciation seems to be over, that can create a situation where foreign investors are buyers and Indian investors are buying. And you can always justify that on the basis of current account deficit reduction and political uncertainty being over in the next 3-4 months and some earnings improvement in corporate banks, blah, blah, blah. So all that can be justified. First we need an environment where people are willing to look at equity and not be weighed down by the fact that every day the currency depreciates. I'm talking from a foreign investor point of view.
Samir, there's much talk about the heightened volatility that the event elections may throw up. Do you believe that it's going to be really that choppy and a cliffhanger in that sense, both for politics as well as the markets? Or do you think it's going to be, as always, as history has told us, election years have given markets positive returns, at max a 2-day event?
The thing is that it would have been a bigger event if the in December the results had not been like this, because right now you cannot build a scenario that BJP is definitely winning with a big margin and therefore there's a negative surprise that day. So I think markets will now discount it a little better, and of course on that day there will still be, I think, a 4-5% kind of move either way depending on who wins and loses. But unless the scenario throws out some very bad individuals as PM, otherwise I think it will be a 1 or 2 or 3 day event, but it will still be worth 5% either way, which is like a 10% difference. But that is not a showstopper in markets, where anyway markets are so volatile these days that you will not hold back your buying because it might fall 5% that day, because it could also be a scenario that it goes up an additional 5-7% that day. But it's not a 20% up-down kind of a scenario which we had in 2009 and before that also, before.
Yeah, so many, Samir, are saying that this year would be really a year of 2 halves. Do you see it like that? Into the budget, the first half, there would be a different portfolio strategy versus what happens post-results, into elections, sorry.
No, I don't feel that. But I feel good in the sense that I think that, if the US dollar depreciates a little because they have one interest hike instead of 2 or something like that, and then Indian rupee strengthens by 1 or 2%, I'm telling you, it makes such a big psychological difference to foreign investors. I think foreign investors can handle normal equity markets, which may be up or down, but broadly there is a big selection of stocks to choose and you can choose what you want. So once the currency scare is out of the way, which I think already is, I think foreign flows will turn positive. Now the only thing I feel is that you can't have a runaway kind of a rally, which would mean something like say 20% before elections, because that people will still like to negotiate. But based on their other comfort factors and the fact, at least that's what I believe, that election day or election week cannot bring you down more than 5-7%, whatever be the scenario, unless it's a super bad, low probability scenario of some lady leading a third front kind of a scenario, then you won't wait overly. So you will go along with a normal expectation that over a year you'll make this much. So I don't think it will be a big showstopper, and you don't need to really change your stocks. You may keep some money in reserve if you want, but that does not mean you'll buy different kinds of stocks. You'll still buy the same which you always buy.
US markets have fallen and we are holding on. US markets fell more, nothing got affected because the view was that okay, US economy will peak out, emerging markets like India will do well. I remember a similar scenario got played out for 6-8 months in 2007 when subprime crisis appeared in the world. US markets started coming down, emerging markets like India, it started moving higher. Everyone on the show came and said that don't worry about US markets, we are decoupled. I get the same feeling right now that we are decoupled. But after 7 months, the decoupling got over and we got recoupled again.
We are not decoupled, but please note that last year the US market fell 6%. So don't get carried away that India did very well. The US market fell 6% in the total year, and it fell out of that 14 or at one point 15% in December for whatever reason, but we also fell some 14% or 10-12% in September. So I don't think it is decoupled. That's why I say that for making absolute money, you want the US market to do well or at least be stable. To outperform, you may do it if something very specific to US happens, but normally US is the mothership. You don't want to wish bad for the US market and think that we will do better. But I don't think US is in that kind of a situation of a 2008. Please note that 2008 itself came after 70 years. It is not a normal bad year. Normal bad year you can do a little better, little worse. But 2008 was like a global crisis. Not even 2000 was not like that. So you cannot benchmark things out of 2008.
And I just wanted that clarification because a lot of viewers, they ask us these questions, and history is evident that your mind just wavers there. So Samir, my next question would be on consumer stocks. These are expensive stocks, but it's not new. They were expensive in 2015, 16, 17 and 18, and yet if you bought an HUL, yet if you bought an Britannia, if you bought a Marico, you've made serious money. What is the way forward for consumer staple stocks? They are expensive, but will they make money?
If you're talking only about these kind of stocks, which is consumer staples, which are trading at say 45, 50 times, if you notice for the last 7-8 years, their earnings, their stock appreciation has come more from re-rating of that earning rather than the earning. So those kind of stocks we don't buy. We want a stock to be going up, maybe a little bit because you discovered it early, its rating has gone up, that is say price earning multiple. But you want the most of the stock returns to come from earnings growth. And in all of these you will find that maybe 80, 60, 70% has come just from PE being higher. But if you broadly define the consumer, we define it much more broadly because there are at least, you could call auto, half of it as consumer if you leave out the HCV and commercial vehicles and all. You can do media, you can do normal consumer durables, air conditioning companies. There are so many companies you can broadly define as ultimately consumer and not corporate or industrial. So that way we like, or even Titan. This is what you can call consumer. But if you say consumer staples, we won't buy any of them.
What one is seeing, Samir, in the market is this kind of portfolio churn or sector rotation which is taking place. A lot of people are now saying that bet on the beaten down names like infrastructure and select autos as well, which you just reiterated too. Are you of that belief too, that there is some serious money to be made in some of the beaten down names because that's where you're going to see an earnings revival and the sectoral churn is also going to be in their favor?
Well, this is a line, but everybody has some beaten up names in their own portfolios. So you don't need to look out for more because if you have 30, 40 stocks, some will be beaten up. But I would say that actively seeking that as a strategy, I don't think it is so straightforward because you could also have a negative scenario of two kinds. One is that US has had basically a 9-year run And that is the longest or one of the longest, maybe I think it's the longest in terms of their business cycle. And if they have a problem, as we say, the world has a problem. And in India, you could have a third front led by some ladies from somewhere, and that would be even worse. So you can't totally go one way or the other. We run a portfolio with about 35, 40 names, but of which some will be the largest names which are doing well, and you feel comfortable that they won't blow you up in a bad scenario. So there is no one strategy, but if somebody wants to buy two beaten up names, he's most welcome to. We are sure we already have some of them in our portfolio, so we are okay. But it's not a strategy. That way, if I buy one stock from this sector, one from that, it's not a strategy, it's a diversification thing. But I don't think it's a full-blown case for buying beaten up, because some stocks rightly deserve to be beaten up. Some have their lives changed with new changes in the world. So there is no such strategy that anybody should have. But you can buy a stock on this basis because you otherwise have some confidence that it will recover whatever it has lost and more.
We were having this discussion just earlier on whether Yes Bank becomes a case to look at these levels.
Well, we are not supposed to discuss stocks. But in a big picture sense, I can tell you that there are very few stocks which have so low hurdles to cross.
And what about some of the infrastructure names or the select auto names which are getting thrashed because their monthly sales data is slowing down?
So we have Maruti. We don't have the others because it is sort of still a dominating thing, and it's dominant company, and it has fallen a lot. Although we've had it for long, maybe 5-6 years. But otherwise, we are mostly short some of the other auto two-wheeler types.
Samir, let's talk about IT. Now, the variable factor in 2018 was rupee. I remember when we started the year, you said, for the first time in my life, I've gone short on IT. I've never done that. I think we had this conversation in 2017. 2018, it turned out to be a great year for only 2 or 3 large IT names. I mean, the mid-cap IT didn't do well. It was only TCS, HCL Tech and Infosys. Given that rupee is now decisively trading below 70, what is in store for IT stocks?
So, that was one of our bigger goof-ups, that after the very poor Infosys guidance in April of 2018, we did not have any IT. We sold off what we had, thinking that again they are disappointing. And the markets went up, and these stocks, the market didn't go up, but these stocks, all of them did very well. So today I would think it is complete, although we own very small weightage, not in this stock, but in general in some IT stocks. But I would think I don't like it now because A, they have outperformed a lot, whereas the earnings are big deal, some 10-15%, which every company in India, any good, has. And they've got re-rated on the basis of these macro factors, and some of them, as you're right, are. So it's better to be domestically oriented, where there might be an interest rate cut, where, you can say capex cycle is recovering, if at all, a little bit here and there. But I don't like IT. We have a few stocks, but much less than the index.
Short fund, Samir, you've always maintained a ratio of long and short. So for 2019, let's say if you have to look at your long short positioning, are you likely to remain more long, less short, or it's too early to get into that kind of a conversation?
Two things are wrong here. One is that as if you have a view for 2019 on the net, on the short side, we have maybe 30-day view. Long side, we are always 100 long. And short depends on the individual stocks, and once in a while on an event like when the introduction of long-term capital gains happened on that one day in budget day. So we might reduce it by 10-20%, but otherwise we are normally in the 60s range. We very rarely have more shorts than longs, so we are not going to have that. Even today we'll be between 65 and 70% net long, which means some 100 long and 35 short or 32 short. And that depends on individual stocks if we add or subtract. But we are not going to say that for this year we'll be this much, because shorting is more flexible in our minds than the long. Longs we want to hold for long. Shorts depends on our view and our confidence.
Fair point. Thank you very much. So Samir, in 2000, a lot of parallels are also been drawn between 2013 and 2018. In 2013, rupee went down, crude went higher. There was a bit of a global, concern because of taper tantrum. But after 2013, mid and small cap stocks came a big comeback, and you also ended up buying a lot of mid cap stocks. I remember one of the stocks where you made serious money was Everready. Are you looking at hunting in some of the mid and small cap stocks? Do you think for an individual stock picker like you, the pond has now expanded and you want to go back to the basics now and you're hunting in that, fishing in that pond?
No, we are not hunting. But let me tell you that this 2013 connection you can also draw in 8 and in 11 and in 13, which is that when the Indian currency depreciated between 10 and 15-20%, I mean not 20 but whatever, 17 I think in 2008, then the following years were very good, and for the following few years, because the currency did not depreciate, it added to returns for everybody. So that way I agree. But in 2013, one reason was actually the political event, which was a super positive and strong event of 2014, which basically led to that rally. That kind of an event does not exist right now. So that big pop, I don't think we are getting with this. And also, because the US market is more into the cycle, you will always feel that if not this year, then next year US will have a recession. And so we may outperform, but we can't have those kind of years that we had in 14 where NAVs were up 70-80%. It's not going to happen. This is more a normal year, I think.